Hot off the presses, we have a new jobs report for the month of July. We've found that the U.S. economy added 114,000 jobs in the month. That's significantly below expectations of 175,000 that economists had. Meanwhile, the unemployment rate rose from 4.1% to 4.3%. What's your initial reaction?
My initial reaction was honestly the market's initial reaction. My initial reaction was, oh, goddamn, that's not good.
Yeah.
And the market reacted violently. We saw, I think it's the worst day since the March pandemic, or the beginning of the pandemic.
Yeah.
It's not been good. The S&P dropped 2.5 points. The NASDAQ dropped like 3 points.
Yeah.
So there's a lot of fear going on right now.
Mm-hmm.
That's basically my initial reaction.
Yeah.
What was yours?
I was the same way.
Yeah.
I was very spooked. And immediately I started thinking about why this happened. And the obvious reason that everyone is pointing to that I'm seeing is the Fed.
Yeah.
And interest rates being as high as they are. Interest rates are still right now pegged between 5.25 and 5.5%. It's the highest they've been in decades. They've been sitting there for over a year now. And my first thought too was, God damn it. Because the Fed just had their meeting 2 days before this report came out. And they were like, they've started to moderate because for months now, or over a year now, their main focus has been inflation.
Right.
And they've changed the language in their report to be like, we're now sensitive to risks on both sides because the Fed has two mandates: keep inflation down and keep unemployment low. Well, now they're saying they're sensitive to both the inflation and the unemployment side. And I feel like if they had gotten this data, they would have been much more likely to have cut at that meeting. But instead, the data came 2 days after, and now the Fed isn't meeting again for 6 weeks, which, even though this is relatively short term, I do wish, and I think we're going to look back and see that they made a mistake by not cutting at this July meeting. I just wish they would have realized that there's going to be a lagging response to interest rate cuts, that the data that we get so far is still relatively lagging, and that if we're probably on a more decelerated path, both in terms of employment and in terms of inflation, than they accounted for at this meeting.
Yeah, and that's a really good point. They only met 2 days ago, and senators, specifically Senator Elizabeth Warren, has come out saying, Jerome Powell, do not wait until September 18th. Meet again. Meet right now and cut rates that you should have done 2 days ago. Mm-hmm. Elizabeth Warren and other progressives in the Senate and the House have been clamoring for Jerome Powell to reduce rates over the last 6 months. And honestly, you would not have been, crazy to think that they were being premature with those calls. But now it's obviously clear now is the time. And so it really makes you think like, wow, maybe the Fed should have gotten on top of this and not have been responsive to it. They should have been proactive.
Yeah, that's the problem is that since inflation has been the main issue for so long, like the majority of people, I don't think faulted the Fed that much for holding off on cutting rates. Mm-hmm. Even before this report, I think fears probably would have been building, but at least around half of economists and people that pay attention wouldn't have been like, it's not a huge failure of the Fed to not cut.
No, sure. Right, and it's been kind of almost priced in that the Fed was probably going to do rate cuts in September. Yeah. That's always been like the general consensus since June, since May. That's been the consensus that the rates are going to come in September. But I guess I want to ask the question of, is this only a Fed problem? Or do you think there was anything the Biden administration could have done differently that could have stopped something?
That's exactly what I've been asking myself. And I don't think so.
Yeah.
It's relatively short term. This is kind of where the Fed operates. And of course, the Fed is independent of the president. So hopefully something that our viewers can understand that maybe the general public doesn't always understand is that how the economy behaves in the short term is almost never attributable to the president or like policies that he does. I don't think he could have done anything. Do you have any ideas?
No, I mean, there was really first of all, there was no political capital nor the necessity to really turn on the government spigot and spend more money.
No.
That wasn't necessary.
No, the economy has still been strong. This is the reason that the markets are reacting so poorly is because this is the first time that we're really actually worried about a weakening economy.
But also what's interesting is 114,000 jobs isn't like a historically bad jobs report, right? Like during the last years, the Trump administration, even pre-COVID, like 2019, the average, there was plenty of months where the job growths were 90,000 jobs and no one was batting an eye about it. Everyone thought it was fine.
Yeah.
So, but it's just in the context of where we are now that it's nerve-wracking. But the concept of it being nerve-wracking, I said that my initial reaction was fear.
Yeah.
And then after a little bit of further analysis, I'm not as fearful. I think it's a short-term hiccup in a longer-term recovery. Okay. And where I come from this is when we look at like the labor participation rate, specifically among prime age workers, so that's 25 to 54, it's reached its 2002 high. It's the highest it's been since 2002.
Okay.
Which is a really positive sign. That means that when we see the unemployment rate drive up from 4.1 to 4.3, it's not because of lack of jobs, really. It's more so of more people looking for work. And that's a better position for the economy to be in. Like I would be more scared if we have labor participation going down and unemployment going up. That's where fear comes in. That's what we were seeing during the Great Recession.
Okay.
Right? The Great Recession was unemployment going up, labor participation going down. That's not happening right now. It's a different...
I guess my question is did labor participation suddenly grow much faster this past month than it had in months before?
It did.
Okay, because then I think it makes sense. It makes sense that the unemployment rate would have also jumped up a little bit more.
Yeah.
Maybe the job creation rate is about the same. Maybe the job creation rate will respond to more people looking for work.
If you do a linear regression of post-COVID labor participation, the derivative of this point is higher than the slope of that linear regression. Okay. So it's on like the higher. It's a faster rate of growth this quarter, this month, than previous months.
Okay.
In addition to that, Fitch, the rating agency, which is like a equivalent to Moody's, they're a big financial modeling firm. They say this about the jobs news. The rise in unemployment rate does not reflect workers losing their jobs. Payrolls have grown at an average monthly rate of 170,000 over the last 3 months. Rather, it's a reflection of expanding labor supply. The working age population increased and the participation rate rose. That bodes well for a further easing in the labor market conditions, which will be welcome to the Federal Reserve. This helps turn the key a little further towards unlocking a September rate cut. That was Fitch's reaction.
Okay.
And I think that makes sense to me because one of the things that the Federal Reserve was combating was a tight labor market. And tight labor market is very good for wages, but it's not good for inflation.
Yeah.
Right.
So you think maybe, okay, but I just feel like inflation has already moderated.
Yes.
So did we really need this additional slack in the labor force?
And I don't think so.
Yeah.
I think that was the Fed's miscalculation there.
Yes.
That was what they shouldn't have waited for. They were waiting for a break in the labor market when they shouldn't have done that.
They didn't need it.
They didn't need it.
Yeah.
When we look deeper into this and we look at the unemployment rates, it's stratified across different demographics in our country, and the one that I want to focus on is education level. So the unemployment rate for somebody with a bachelor's degree or higher is 2.3%. Unemployment rate's extremely low. But when we look at less than a high school diploma or a high school graduate, it's 6.7% and 4.6% respectively. So what's happening here is the unemployment, which is fairly common. You're supposed to have the stratification between the different education levels, but this is a widening of that than what we've seen over the last year or two.
That's interesting because the narrative that at least I have heard a lot of recently is that blue collar jobs are where a lot of the openings are currently happening. And you would expect that would, instead of further stratify the differences between the educated and the less educated, would be that it would crunch them together.
Well, it may be that the people joining our labor force are the less educated. And that's why those numbers are going up so much more rapidly.
I see. Yeah.
Right?
That makes sense.
That makes sense. And especially because our labor force participation is growing because of immigration, right? That's another thing. Immigration did slow this last month, which we will talk about on a later segment this week. But that's still those effects of our heightened immigration over the last 2 years. They're going to be felt for a little while.
Yeah. Okay. That makes sense. Do you think we're at risk of a recession?
No, I genuinely don't.
Okay.
I think once we have an interest rate cut, the markets are going to boom very fast.
Sure.
I think there's going to be a lot of investment very, very quickly.
I'm a little skeptical because the markets already are pricing in a rate cut, I feel like. So my other question is, how much do they cut?
That's my question, dude. That was going to be my question to you too. So originally what we thought was it was going to be 25 basis points, which is 0.25%.
Yeah.
In September. Now I think they're going to do 50 basis points in September.
Really?
And I don't think that's going to be the only one for the rest of the year.
No.
I imagine there's going to be 3 rate cuts.
Yeah, I agree. I'm hoping for the 50 basis points, but I'm also worried about the Fed being overly conservative.
Mm-hmm.
I think the markets are going to react poorly if it's only a quarter point of cuts. I think it will be relatively neutral, if not slightly positive, on half a point. But I feel like the general macro picture between the market and interest rates having set in for so long is that the market is starting to get slightly more bearish on AI, and there have been a lot of earnings reports in the last week that are kind of discouraging people. I think that's going to reduce investment at least in a lot of tech companies.
Yeah.
It might help rotate investment back into smaller companies, but then again, if there are these greater fears of a recession, then people are also that's going to hit smaller companies harder.
Yeah.
So I'm worried a little bit about downward spiraling, and I feel like, honestly, I can imagine a 0.75% cut or even a 1% cut being the right move.
Sure.
Just the harder move to make at the September.
Right.
Yeah.
And I wanted to say one more thing about the Intel thing that you were talking about, like with the tech stocks are kind of in a bubble right now.
Yes.
I mean, they're very overvalued.
Yeah.
And so Intel probably isn't overvalued, I think, because Intel actually reached like their 25-year low.
Yeah.
So probably Intel
just dropped 30% today.
Yeah, Intel isn't the right example.
No.
But
Nvidia.
Yes. Like a lot of these stocks are overvalued, and declines in those stocks aren't going to be like signs of recession, I don't think.
No.
They're just signs of, reality. Their market capitalizations are not true. And so they need to come back down.
Yeah, my worry is just whether does that scare people away from investing in the economy overall?
That needs to be seen. But that's what needs to be seen.
Okay. The last thing I want to ask about, do you think the breakdown of jobs, does that mean anything to you here? We saw continued strength in healthcare and education jobs. We saw strength in construction, which I think is encouraging because some investment in residential construction was probably happening here. We saw loss in information technology services jobs. Does any of this mean anything to you? I feel like it's generally a bit noisy.
Yeah, it's very noisy. I mean, you have to look at it on the larger picture. What we basically have seen over the last 2 years is increase in construction jobs, increase in manufacturing jobs, increase in healthcare jobs and education jobs, increase in government jobs. All that has kept happening, just to a little lesser extent.
Yeah.